Risk parity is not a product, but it's really more an intelligent way of putting together a truly diversified portfolio in different asset classes. So it's really, in a way, an investment philosophy or a particular way of investing and generating positive returns year after year. So it's really an absolute return product, if you like, or process, and it works successfully, as you will see during the course of the next few minutes. It is interestingly not really a niche strategy, so it's not something that no one understands. In fact, it's very intuitive, it's very clear, but conceptually it's something that has not been so popular in continental Europe until fairly recently, but now we see a lot of institutional demand. Now, what happens within risk parity? It is an investment in different asset classes that are uncorrelated to each other. So that means they do not all go down or up at the same time, but when one goes up, one goes down. So it's a very solid approach. It's a bit like the toy on a children's playground, where on one side of the swing there's the more risky assets, for example equities and commodities. On the other side it's the more risk-averse asset classes such as fixed income or short-term interest rates. Therefore, an investment approach for all seasons, for all market environments. And the idea is to invest long only in various asset classes that offer a risk premium, and we harvest, we sort of take the risk premium over time and generate a positive return for our investors. Secondly, and there will be 3 points altogether, secondly, the allocation, so how much is invested in every single asset class, is not just, for example, 25% of the money, but the actual money weight is determined by how risky the assets are. So the risk of the individual asset classes is the starting point in risk parity. Therefore, for example, equities, which are much more volatile, get a lower weight, and bonds, which are less volatile, get a higher weight, so that from a risk point of view, therefore risk parity, in our case we've got 25% of the true portfolio risk from each of the 4 asset classes: equities, bonds, commodities, short-term interest rates. Thirdly, that sounds too simple. Does it work? Yeah. Yes, it does actually. In our risk parity strategy since 2004, because we like to think that the choice of asset classes is a good one, we have generated positive returns for our investors every single year at about a level of 8% annualized. The second question, how does it fit into institutional investors' overall portfolios? Evidence has shown very well. Why? Because it is a true diversifier. So allocating to a risk parity approach lowers the overall volatility of the investor's total portfolio, and that's a good thing. Less volatility for the same return, or indeed an even higher return, is good. It makes the whole investment more efficient, and as you know, we like efficiency.
Però quando si guarda in una visione globale, completa, insomma, di un portafoglio, c'è sempre paura, almeno parlo personalmente, di incappare in un errore, di qualcosa che passa inosservato, in un piccolo trabocchetto. Allora si tratta di capire a cosa bisogna stare attenti, what are the pitfalls of the risk parity strategy.
Yes. So the pitfalls really, what can go wrong, or what has one to look out for. And I think there are really two things that every investor should look out for. The main mistake that can be made is that a risk parity approach, and it's not just ours, there are a number of risk parity approaches out there, that effectively the wrong asset classes are chosen. By that I mean, coming back to that it should be uncorrelated. What seems to be uncorrelated, for example, equities on one hand and high yield bonds. What seems to be uncorrelated is actually not when markets go down. Then equities go down and high yield bonds go down at the same time. You've got a correlation in the wrong direction, and that is a mistake. This is a pitfall that is really, really, really important. And secondly, I think it makes sense for every investor, for everybody who's interested in risk parity, to look at the actual, real track record of companies. How did the different companies manage to steer through crisis, 2008 in particular? It's really, it looks easy, but it's not. And the wrong choice of asset classes, the wrong portfolio construction process can lead to very poor results. Some risk parity strategies were down 15–20% in 2008, in the very bad equity year. Our strategy was positive about 9%. So this shows how important the right choice of asset classes is within the risk parity concept.
In parte ho già risposto a un quesito, un interrogativo che mi pongo, perché viviamo in un momento di tassi bassi, l'ho detto in apertura Gaspari, e i mercati vanno in una certa direzione con un po' di isteria, un po' di volatilità, ma il rischio che aumentino i tassi e che, soprattutto per l'Italia, insomma, che molte strategie saltino, c'è ed è forte. Allora mi interessa capire come funziona il loro approccio, la loro strategia in caso di crescita dei tassi di interesse e del rendimento delle obbligazioni. How does it work? Your strategy when there are an increasing of the interest rates and for the government bonds?
Yes, it's a very good question. And it's something we could talk about for 2 hours, but I will not. Really, this point of potentially rising bond yields brings us back to the fundamental logic of risk parity. Why? Let's say at some point interest rates go up or bond yields go up, and we will see when it happens, how fast it happens, but let's say at some point in the future bond yields go up, then yes, it will be not good for the asset class bonds. But there will be a reason for bond yields to go up. For example, that the euro crisis is over. The fundamental outlook for the world economy is better. So we might not get a very good return from bonds, but it's reasonable to assume that the return from equities and commodities will be good. In fact, better than the not so good returns on the bond side. If bond yields go up, and no one talks about this right now, because inflation goes up sharply, then commodities, which are part of our risk parity allocation, will benefit. So the same concept holds true. Not all 4 asset classes, equities, commodities, bonds, short-term interest rates, will always participate positively or contribute at all times, but at the same time they will never, hardly ever go down at the same time. And if it happens, and we don't forecast these things, no one can, but if it does happen, very rarely that all asset classes go down at the same time, equities go down and bond yields go up at the same time. Unusual, yes, but it can happen. Then we've got a risk management system that purely quantitatively, purely systematic, without emotions, will reduce risk, and we will not have a loss that is greater than, for example, 4%. So, really to conclude, if I may, risk parity is a very good, I think, way of investing in a truly diversified portfolio. It is there for all seasons, for all market environments, and every investor can choose between how much risk, how much volatility is chosen. In continental Europe there is one appetite. For example, in Great Britain the appetite is usually higher, and I've just been to Japan for a week where the risk appetite is lower. They've got low interest rates for a long time, so there is a more realistic approach. And as you can see, I could speak about this for hours, but my time is over, so thank you for your question.